Now, next up with us, we have Mr. Stephen Hall. Steve and his family for the last 4 decades have, as I mentioned earlier, advised real estate investors, business professionals, individuals of all walks of life, and those individuals of significant net worth, how to mitigate their taxes, how to save your money. Steve has saved my wife and I a bundle by utilizing different entities for our apartment ownership, different investment vehicles. And Steve, aside of that, today, given the recent events, will share with us what can he pick apart of what's been proposed in the tax code, and what and how is that meaningful to apartment landlords. So with that, I welcome Mr. Stephen Hall.
Thank you, Chris, for the introduction. I'm excited to be here. Considering the circumstances, I'm very happy that Chris was able to convert this to a virtual meeting for all of you landlords to see what's happening today. I want to give you an update on what's happening from a tax perspective and where we're going to go with the climate of this current pandemic and how regulatory-wise that will affect all of us here. This first picture I want to show you is a picture of a woman that came into our office last week. As you can see, she was clearly concerned. She had a plastic bag over her shoes as if she was going into a surgery. She had a plastic bag over her head and her hands like gloves and her shoes. When I saw this picture, the first thing that came to my mind was, how are our tenants going to react? How are the citizens of this country going to react to the situation? But more importantly, what is the Treasury Department going to do? What is the IRS going to do to address this situation from a financial perspective? Personally, I've been involved in the 2001 crisis, September 11th, as well as the 2008 financial crisis. So this is going to be my third economic downturn to assess and to advise clients and landlords about how to be prepared, about what just happened, and more importantly, how to plan for the next 24 months of what has just taken place. Because this picture spells out the mindset of majority of your tenants and some of your folks, your neighbors, even myself and my family members and your family members. And so it's important for us as leaders and landlords to be educated with the right information so that way we can help calm down our loved ones, our neighbors, our tenants, as well as our supply chain, such as our contractors and our vendors and handyman, gardeners, etc. So today the goal is to really go through from an IRS perspective, what steps are being taken to address this situation, and more importantly, if you are experiencing a loss, a financial loss, how can we utilize that loss and go backwards to save you additional taxes from taxes you've paid in the past. To give you a little bit of a background, Robert Hall & Associates has been in business for the last 4 decades, and we focus on tax accounting and tax advisory work for landlords. And we have a large staff of over 30 folks that can service you. First off, I want to go through what has happened literally yesterday. The IRS has changed the deadline to pay taxes to July 15th of 2020. But the confusing part is the tax deadline for you as a landlord is still April 15th of 2020. So the deadline to file the forms is April 15th, but the deadline to pay the taxes on the forms you filed on April 15th is now July 15th. However, if you need additional time to file the forms, you can go on extension on before April 15th, and that extension gives you until October the 15th to file the forms. But the money that you may owe should be paid no later than July 15th to prevent any penalties or interest on the taxes that are due. So that's the first change. The Treasury Department defined in writing as of yesterday on a press release. The Franchise Tax Board, the state of California, extended the deadline to file and to pay taxes to June 15th of 2020. At the bottom there, I put down deadline to pay taxes June of 2020. So what I'm referring there to that point is the deadline to pay taxes and to file the tax return for the state of California is June the 15th of 2020. Now keep in mind, as we all know, the last 5 days, there have been many changes with policy from local counties. For example, in Orange County, the county has wound down their services except for critical infrastructure services, and all the way to LA County, to the cities, municipalities, etc. So we're going to see evolutionary changes. And so if you want additional updates later in the program here, we're going to give you an opportunity to text us your information so we can keep you abreast of all the new regulatory changes that will be coming as a result of this crisis. Because keep in mind, the Treasury Department here wants all of us to create stability in the economic system. And as a result, they're going to do whatever they can to create relief for us now. Because all of you that are listening to this today are part of the top 5% of the American public that can invest and reinvest and redeploy your capital into the economy to keep the jobs going. Because right now, the preliminary unemployment rate that they're forecasting, if they don't take a corrective, quick action, is 1 out of 5 folks will be out of work, 20%. That's what they were claiming, that the economic forecast to be a 20% unemployment rate as a result of this catastrophic event. The good news is the Treasury Department acknowledges this, and they want to take rapid action, which is why you see today on this slide, the IRS is extending the time to pay to July 15th, and they're talking about additional legislative action. So let's look at the potential actions that they want to take. At the top here, I call it the COVID tax strategy. These 2 items are available to you now. The first one, if you are an active stock trader and you have substantial losses in your portfolio and you're actively managing your portfolio, you could potentially file what's called a stock trader election. It's called a market-to-market election. And this election is valid till April the 15th to file with your tax return saying you want to be a market-to-market trader effective January 1 of 2020. So that way, if you have substantial losses in your portfolio for the 2020 year, you'll be able to deduct 100% of those losses if you qualify for per the market-to-market rules of those losses against your other sources of income, such as your profits from your apartment buildings, etc. The second item you'll see here is called a Roth IRA conversion. What a Roth IRA conversion is an opportunity that if you took substantial losses in your retirement account, you could convert your entire or partial account with your broker-dealer to convert it to a Roth IRA. As we have all seen the last couple of days, oil has come down to their all-time low. We're at a I believe it's the 3rd lowest price per barrel in history. So if you have oil stocks or if you have stocks in your portfolio that have taken a substantial reduction in value, this may be an opportunity for you to convert to a Roth IRA today. So that way you can capitalize on the future growth of that account while you're paying taxes on the lowest valuations that we've experienced in a long time. Now below, what you're going to see are potential changes to the tax code. The first potential change that has not been defined yet is called the payroll tax suspension. If you have employees that are on your payroll, Congress is discussing to potentially suspend any payroll taxes that are owed for purposes of being an employer. As of today, Congress has not made that change. So I want you all to be aware that this potential payroll tax suspension is not signed into law at the moment. So continue to pay your taxes, continue to pay your payroll taxes, because you will be penalized if you do not pay your payroll taxes. The second item below is called the net operating loss carryback. What this is when you experience a catastrophic event like this, you have a large loss. As of last year, Congress suspended this tax deduction to where if you have a large loss in a current year, such as 2020, you can go backwards a couple of years when you had good taxable income and good earning years and grab all that tax you've paid and issue yourself a refund because you experienced a current year loss. Congress is right now on the floor discussing to put that specific law back into practice to where those of you watching this today, if you've experienced substantial loss as a result of this catastrophic event, and you file a large loss on your tax return, you'll potentially be able to go backwards in time and to grab all those profits that you pay taxes on in the past and potentially get a refund on your taxes on monies you've already paid for the 2017, 2018, and 2019 tax years. Now, these are proposed changes that Congress are discussing, and they have not been passed. But keep in mind, the press release that we talked about on the previous slide, where they want to extend the deadline to pay the taxes to July the 15th, was just put into writing. It was discussed earlier in the week, but it was signed off in writing by the IRS yesterday. So stay tuned for additional updates on this specific events. Now what we want to talk about is the 2018 tax reform, about how this affects you as a landlord and what takes place. The first item that's important is called the qualified business income. What is qualified business income? Qualified business income for landlords is folks that have profits. If you have profits and you manage your business as a landlord for over 250 hours on your property, you may potentially qualify for a 20% reduction in profits that are taxed to you as a landlord for your current year of tax returns as a result of the 2018 tax reform. However, if you have W-2 income, interest, dividends, capital gains, or Social Security, these items are not subject to that 20% reduction per the tax reform. So if to be a qualified business, you would have to be a business that's not in a professional capacity, such as an accountant, an attorney, or a medical profession. However, if you have self-employed real estate income or rental income, could you qualify for it? These are examples of categories that do qualify for the 20% reduction in taxation for the qualified business income deduction. So here's how the flow chart works. If you're married and you have taxable income of over $321,000, and as you can see, according to this flow chart, if you are married and you have taxable income of more than $321,000, and if your taxable income is under $421,000, you get the 20% deduction. But if you're married and you have your taxable income is over $421,000, and you are in a specialized business such as a doctor or an attorney or an accountant, you would not qualify for this deduction. However, if you are not in this specified business, you may potentially qualify for this deduction. Additional changes in the tax code has been mortgage interest. I'm sure many of you have seen the headlines over the weekend that the Federal Reserve Bank has reduced their interest rates to 0%. And as a result, the capital markets have been correcting on their interest rate policy. And Gil Figueroa, that spoke earlier, talked about the mortgage banking activity and what has taken place. And I'm sure he's discussed the volatility that has been taking place in the markets. And the question is, how does that affect you from a tax perspective? There are two forms of mortgage interest that are important with this 2018 tax reform. The first is primary residence taxation. If you're going to buy a house, you can only deduct the first $750,000 of mortgage interest on your tax filing. And what I mean by that is if your mortgage balance is $750,000 and you pay $20,000 in mortgage interest, you are allowed to deduct that interest on your tax return. But if your mortgage, your loan is $1 million, the government will only allow 75% of the interest you paid, or the first $750,000 in mortgage loan balance. So in that example, if you paid $100,000 in interest on $1 million loan, the government will only allow a $75,000 deduction for the mortgage interest that you have paid. So as a result, there are limitations to this deduction for your primary residence only. Also, from a property tax perspective, the property tax and income tax you pay to the state of California is capped at $10,000 for your primary residence as well as your state income tax. However, if you have a rental property, you are exempt from any of those exclusions. You're allowed to deduct 100% of your property tax, as well as considering the rules that you use the debt to buy the property, you could deduct 100% of the interest on your rental property. So that's good news for you landlords, that you are exempt from the 2018 exemptions and reductions of what can be deductible. The next area we're going to talk about is SALT. SALT stands for state and local taxes. SALT includes state income tax, local tax, property tax and sales and use tax. And as a result of these items that you're seeing on your screen, such as DMV fees, etc., the cap that you could deduct for your personal tax return outside of your landlord business is $10,000. But if you're a landlord or a business owner, you can still deduct your taxes under those specific tax forms. So the big question today, especially with what's been happening, is should I incorporate considering the tax bill? Do you need to incorporate? The answer is no, you do not need to incorporate just to save money on taxes for the 2018 tax reform. But if you're concerned about asset protection and you're concerned about what kind of entity to use, the entity of choice that most landlords prefer, and Steven Spear will talk about this later on today, about the benefits of a limited liability company and how it can protect you as a landlord. Other vehicles that are popular for business owners is what's called a C corporation. I call these corporations benefits companies. So if you're experiencing large medical expenses because you're taking care of a family member that's a dependent of yours, let's say your husband or wife is in a nursing home facility and you're paying for those costs out of pocket, it may be worth our while to review this type of tax structure so that way we could deduct 100% of those expenses that you're spending to support the loved one and the medical care, et cetera, that you're experiencing. So for landlords, C corporations are great if you have an extreme example of paying for health care. Another vehicle that's popular, typically property management companies are set up this way. They're set up with what's called a subchapter S corporation. And a subchapter S corporation helps reduce the amount of Social Security tax you could potentially pay on your behalf as a property manager. And we could discuss that in further detail through a special 30-minute free consultation that we'll discuss at the end of this presentation, where you can ask us all the questions you may have. In fact, today we will be discussing on our panel several questions and answers session, and we can go through some potential questions you may have about those areas. So the big question is, should you have insurance or should you have an entity? The big difference is an entity helps you as a fail-safe alternative. However, insurance is very important to have as your front lines because insurance will help cover your legal defense costs if it's set up properly. And Steven Spear will discuss in further detail the benefits of having an insurance policy versus strictly an entity. The big question we get is, hey, if I invest outside of California and I receive profits from properties outside of California, but I'm still a resident of California, can I prevent paying California tax? And the answer is no. You have to be a non-resident of California earning income outside of California in order to have the benefits of not paying taxes to the state of California. So this year, when you look at our tax brackets, you'll see the top bracket is 37% for taxpayers that are single, for income that's over $500,000, and if you're married, it's over $600,000. These rates have been reduced from the higher rates that we've experienced in the past. And if you have specific questions about your taxable income and where you fall in the brackets, we could discuss that in further detail through our one-on-one consultation. So the big question we get is, I've been a landlord for 20 years. I've been depreciating my property for 20 years. How do I avoid paying the recapture on depreciation tax? The most common way to do this is to file what's called a 1031 exchange, where you can trade your property from property A to property B to prevent paying taxes. Or if you are married, you have a spouse, and when your spouse passes away, the government will allow you to reset the valuation of taxation, so that way you don't have to pay the depreciation. So it's going to be important that we have interactive conversations with you to plan accordingly to see if it's even worth selling the property or if it's worth keeping the property long in advance before you decide to list the property, to plan ahead about the tax ramifications of your situation. Robert Hall & Associates has what's called a free tax consultation that we can provide you. It's a 30-minute complimentary consultation that we'd love to help all of you to address all of your concerns and your questions. And I know many of you have many questions about what has been taking place in this environment, and we definitely want to assist you with this, the circumstances and facts of what has been taking place. And what you can do is text us through your phone device today, and the text is 38470. I'm going to repeat, the code is 38470. If you have any questions, or even if you have concerns about what to do with your environment, with your tenants, we'll be more than happy to refer you to the right folks that are speaking today about this unique circumstances that we're experiencing as citizens of this country. And you can always text us at 38470 and give us your name, your email address, and phone number, and we'll be able to address all of your unique questions and circumstances that you may have. Our staff are here 6 days a week, Monday through Saturday, and we have been working with all of our clients literally from 8 in the morning till midnight every day to address all the concerns they've had, because none of us are clear about where this is going to lead us to. But what we're offering is, if you text us at that code of 38470, if we don't have a good answer, we're going to refer you to the best experts in the industry to assist you with your needs. And with that, I'd like to thank Chris for putting together this great program. I'm glad we were able to talk to all of you today, because there's a lot of uncertainty in the marketplace, and we're hoping we can be an added resource to you and your family to make the right decision. So that way, going forward, when we look back 5 years from now, we'll be all satisfied about how we manage the current circumstances in the country today. Thank you.